It is Friday, and that means the BLS Jobs Report. Welcome to May 3rd, everybody. Scott Riley with the Market Update Desk. We got that all important BLS Jobs Report, and let's go in detail on it because it gave us some positive information for mortgage rates. So, BLS reported 175,000 jobs created in April. Now, this was significantly below the market expectation of 243. In addition to that, we saw revisions to the two previous months of downward 22,000 jobs. Within this report, we've talked about how the faulty birth death model is skewing these numbers for the BLS report. In fact, for this report, the BLS showed that there were 363,000 jobs created within the birth death model, meaning small businesses opening and closing within the month. Now, imagine what this report would read without that 363,000 jobs, and if it used a correlating number of what the ADP showed for small business job openings of 38,000 jobs. That would have given us a negative 188,000 jobs created. Look at what the media talking points would have been, and potentially look at how the Fed would have seen that and how the market would have reacted. Now, the biggest contributor to job growth was in healthcare this month, and that added 56,000 jobs. That was followed by social assistance jobs, created 31,000. Transportation, warehouse, and retail trade each added roughly about 20,000 jobs. Now, leisure and hospitality, which has been the workhorse for this job gain for the last 18 months that we've been seeing, that only created 5,000 jobs. Now, this does coincide and correlate with the JOLTS report we saw last month, which had a significant drop in job openings, especially for leisure and hospitality. So there is some meetup and correlation within those reports. Now, when we go deep into this report, average hourly earnings, now that measures wage pressure, wage inflation, rose 0.2% and was below the 0.3 expectation that the market was seeing. Year over year, average hourly earnings now has fallen from 4.1% to 3.9%. The market was expecting a 4% number. Now, average weekly hours decreased from 34.4 to 34.3 earning hours per week. Now, interestingly, we are just a couple ticks off of the lowest average hours worked per week per worker since 2011. So that's something we're watching very closely. And when we get this decrease in hours worked, we're seeing a real take-home situation of less take-home dollars for many people. And this is where the inflation pressure is coming in, both from net income and from inflation from goods and services prices increasing. So those are things that have real-world applications. Now, the data we just went over is the establishment survey. This is what the media puts out. This is what you see in a lot of different areas, especially in the politics side. Now, the more applicable survey number is the household survey. Now, this is where they actually pick up the phone, talk to people in the real world, and get real world numbers versus imputed numbers. This showed that there were only 25,000 jobs created, and the workforce increased by 87,000. This is where the unemployment number comes from, which is the U3 number, which is what the media talks about. That crept up from 3.8 to 3.9%. This is the highest number since January of 22. Now, as this number ticks up, this is the driving force that will move the Fed even more so than inflation numbers, because inflation is going to take a while to come down. If we see this go to 4.1, 4.2% unemployment, which there are many economists who see that, we're going to have added pressure on the Fed to look at rate cuts. When we look deeper into the U6 unemployment, this is by far a much more broader calculation for unemployment than what the headline number is. It takes into account real world situations. It doesn't take people off the unemployment survey after 4 weeks. Now, this showed that unemployment rate rose from 7.3 to 7.4%, highest reading for the U6 report since November 21. The Fed is going to start paying more attention to this U6 report as it ticks up. And this is the number that the media really needs to get out to people to help them understand the true real world situation of unemployment, of jobs, of the economy. Now, when we look deep at these 25,000 job creations in the household survey, there were 949,000 full-time job gains, but with 914,000 part-time job gains. It's showing you the vast majority of all of the job gains, 85, 90% are part-time jobs. This is not how a stable economy is being developed. But unfortunately, the media is not getting this out to people, so they don't get a true perspective of where we are. When we look at all this, it was a positive report for the mortgage market. 10-year bonds, mortgage-backed securities are in the green today. In fact, mortgage-backed securities are up 28 basis points. 10-year bond is down 6 basis points. Those are all great signs that we're going to see. Now, when we look at next week, much calmer week. We've got Wednesday mortgage applications and a 10-year bond auction. Thursday, we've got jobless claims and a 30-year bond auction. From the market analysis, the Dow, Nas, and S&P are still seeing the big earnings reports. In fact, over 80% of the corporations are reporting earnings beats. This is showing that the economy is still very strong. Now, within the charts, we're seeing a little bit of top and bottom resistance levels being hit on mortgage-backed securities. So it's going to be very important to see where we close today, where that can bring us next week. Hope this helps you understand what the numbers were today. We're working all weekend. We're happy to help get you pre-approved, try to get some offers accepted, explain the market to everybody. Give us a call, 616-293-2189. We hope you have a fantastic weekend.